Now's the perfect time to profit as the market continues to trade to new all-time highs. In this report, we'll look at what happened in the US market and what you can expect moving forward. Hello and welcome, and thanks for joining us for this, our first US stock market report for this year. Now, normally I'd be chatting with Jim Beach, however, I'm not really sure what happened to Jim. Maybe he's still on holidays. I'm Dow Gillham, Chief Analyst at Wealth Within, and we're Australia's most trusted stock market educators. Now, before we move on, thanks for showing your support for our channel and just hitting that subscribe button. As you subscribe, remember to click the bell on the right of it so you keep up to date with our latest videos. Now, in 2019, the S&P 500 rose 28.88%, whilst the Dow rose slightly less at 22.34%. Now, would it surprise you to know that since 1950, so nearly 70 years, the S&P 500 has achieved 20% plus growth in a calendar year 17 times? Or in other words, 25% of the time, the S&P 500 rises above 20% or gets a 20% or better return in 1 year. Only twice, though, has it achieved that 20+% growth in consecutive years. Those years being 1954 and 1955, and then again in 1995 and 1996. So given that history says to us that it doesn't have consecutive years at 20% plus growth, the actual probability of it getting above 20% in 2020 is very, very low. So don't expect 20% plus growth out of the S&P 500 in 2020. Now, since 1950, the S&P 500 has closed higher than it opened 73% of the time. So basically, 3/4 of the time, it's going to close higher than it opened. And I do expect that for this year, but just don't expect the spectacular growth that we had last year or 2019. So whilst I expect the S&P 500 to be bullish, it's not going to be exceptionally bullish, and that's really what I'm saying here. Now, the average annual growth of the S&P 500 in the last 10 years was 8.95%. Obviously, that's the index return, 8.95%, which is pretty average. And if you looked at it over that 50, 60 years, you'd get pretty similar returns, around about that 8 to 9%. On the S&P 500. So that's really what it's been doing over the last 10 years. Obviously, if you're owning shares, you'll get dividends as well. Now, later in this report, I will bring up a chart of the Dow Jones Industrial Average and look at where it was and where it's heading, and the overall market is heading in 2020. So there's some good information there for you to look forward to. Now, last year saw some strong performance on many stocks. Now, these strong performers of 2019 will slow down, in my opinion. One example, which I share with you later when I look at the charts, is Apple, and it had basically doubled in price in 2019. Now, I'll share with you on the chart that it will slow and why it will slow. Microsoft, another company, it achieved 58% growth in 2019. So again, my expectation is that it will also slow. So my suggestion is for you to look at good companies that underperformed the S&P 500 last year. So look for companies that got returns of less than 20%, probably even companies that got returns less than 15% last year, because they're likely to play catch up this year. So as the market moves, what happens is the money in those stocks that have been running hard starts to come out of those as institutions and big players start to take profits, and then they start to look for value elsewhere because they've already had the run. So again, you really do need to look at the stocks that weren't didn't get as great a return as some of those stocks like Apple and Microsoft. And again, later in this report, I'm going to bring up some charts of stocks to show you exactly what I mean here. Now, some real interesting news just before Christmas was the deal, the North American Free Trade Agreement, or now what's called the US, Mexico and Canada trade deal, or that deal with Mexico and Canada that the US has had there. Now, just before Christmas, the House of Representatives passed the revised North American Free Trade Agreement. Now, whilst the new deal is not vastly different from the 1994 deal, it will support employment growth in the US. And as we know from my chats with Jim, employment is at its highest level since the 60s. I think unemployment or unemployment is at the lowest level since the 60s. So you can't have that kind of employment. And I was only speaking to somebody the other day in the US, another advisor in the US, and they were saying there's hundreds and hundreds of thousands of jobs that they just can't fill. So to me, you can't have a low unemployment rate or high employment and not get growth out of your stock market. Now, with this free trade agreement, the auto industry is a beneficiary, with employment expected to rise over 7%, with more car parts to be made in North America. And now the deal requires 75% of car parts to be made in the US or Mexico or Canada to remain tariff free. So that's really good for US car manufacturers and obviously manufacturing in general, because obviously manufacturing car parts, you've got to get your raw materials from somewhere. So iron ore, steel, those sorts of things. Also, they've got stricter labour and environmental provisions in the deal. And this is a really, really good sign, because obviously there is concern about labour laws in Mexico, and obviously looking at labour conditions or the conditions of the labour in Mexico. So that's really, really good. And obviously environmental impact is fantastic. Lastly, the dairy farmers have the opportunity, or US dairy farmers have the opportunity to sell into Canada, and that's been restricted by Canada. Now that has opened up. So that's really good for the dairy industry. Now, in finishing up, I know there's been a lot of talk around the US and Iran right now, or those tensions. Now, those increased tensions are getting a lot of people asking me about, well, how is this going to affect the US stock market and indeed world stock markets? Now, pretty much what happened is, obviously, we've seen what's happened in terms of missile attacks, that sort of stuff. But what we haven't seen or haven't talked a lot about is those sanctions. Now, sanctions to hit, the US has added more sanctions onto Iran than what it already did have. Now the sanctions are to hit metals and manufacturing sectors in Iran, and also construction, textiles and mining. Now we need to remember that's not really going to affect the US or the stock market that much, because we need to remember in 2018 Trump reimposed sanctions on oil, financial and shipping sectors with Iran. So interestingly there, I don't think there's going to be much coming out of that whole tension in terms of effect on the stock market. But generally when there's more tension and there's more military action, that is good for the economy, because it increases manufacturing of military weapons and getting preparations and supplying troops on the ground, those sorts of things. But again, I just think that a little bit of a knee-jerk reaction on the market the other week, nothing too much to be worried about at this point in time. So I think it's all smooth sailing for 2019. So what do I expect in the market moving forward? Well, let's get into the charts for our S&P 500 index update for this week. And as mentioned, I'll look at a few stocks that are of interest to me right now. So keep watching.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services license, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Well, it's been about a month since we actually looked at the US market to see what's going on. And I did expect the market would rise up through into December, but it's been a little bit more sideways. But let's go and have a look at the chart of the Dow Jones Industrial Average right now. On your screen is our monthly chart, the one I showed you in December in 2019. Haven't changed a thing, and I kept it very much the same just so I could share with you what I'm actually thinking. And you can see here how the market's just slowly moving up through here. And if I expand that, you'll see so far January hasn't really done much. Other markets around the world have done a little bit more than what the Dow has through here. But you can even see here it's just slowly moving up. And if we look back, and if I do this, I'll show you what the Dow's been doing over the last couple of years. So this bar here is January 2018. So that's where we started off in January 2018. The Dow opened at 24,809 and up till the end of last year, 15% growth. And so right now we're looking at 2 years of growth, around about 15%. It's about average. The Dow average is around about 9%. per annum, and that's really what it's doing. Now, the S&P 500 last year made about 20, I'm trying to think of what it did. It did around about 29% or something like that. We also saw the Dow about 22% growth last year right through here. But right now what we're looking at here is that the market's not pushing on strongly, although the economic data for the the US market is looking good. I mean, low unemployment, all sorts of other things, trade deals going through. But right now I do expect the Dow to move through right up into this 33,000, possibly 34,000 points over the coming sort of next 6 months. Now, I think the market will be bullish for a few more weeks, probably to maybe mid-February. We might see 1 or 2 weeks down, or even up to 3 or 4 weeks down, but probably 1 or 2 weeks down, and then for it to move. But I think once we break clear of this sort of whole sideways-ish move, I think what we'll see now is the Dow really take off a little bit more, because it really has held back. And we can see here how it really took off through up into that 2018 high and really gone sideways and done nothing in the last 2 years. So what happens is with markets and stocks is they do what they call equilibrium, and so when they break out, they run a bit hard and then they go into phases of equilibrium where they run sideways a bit for a period of time and just sort of catch their breath before the next move up. And I think we're going to get to that next move up. I am more bullish on the Dow over the next 1 to 2 years. I do think the next major low is going to be sort of 2022 to 2024, but right now we don't need to worry about that. Now's the time to still buy stocks and look good, or everything is really, really looking good. But let's go into some of the stocks that I wanted to look at now. Okay, now I've picked some of these stocks really just to show you I'll give you some interesting insights at how the market works. Now, we have seen some spectacular rises out of some of stocks throughout 2019. Remember, because the market was pretty, it was an excellent year on the US market, even though this time last year and even earlier, right through sort of September, October 2017, everybody was talking about market crashes, GFC style events and all sorts of different things. They had all sorts of metrics coming out, or wives' tales coming out saying this is happening, that's happening, the market will do this. And I know for those of you who are watching my reports all through 2019, I kept saying, what a load of hogwash, the market is bullish, it will continue to be bullish, don't listen to these sorts of things. And this is really what's happened. It's been one of the better years. Now, we're looking at the S&P 500, about 70% of the time it closes higher than it opens for the year, but over 20% gains in a year, that's rarer, and you don't get that too often. Now, we did make an over 20% gain in 2019, so having 2 years in a row over 20% is even rarer. So don't expect as spectacular growth, but there's still some good growth. Now, what I'm looking at on the screen is Tesla, is probably the first stock that I wanted to look at. I know Jim and I, during last year, he was more bearish on Tesla and I was more bullish, and Tesla's done very, very well since that mid last year. So we're looking at there on my pointer there saying low of 176.90 in June 2019. So you can see if I put my little pointer here, we measure that range through to that high there's 180% growth right through to currently it's 170.15% growth. Spectacular growth on Tesla, but how long can this last? And what actually happens is a lot of people tend to get in at the end of a run. They see the stock moving up. They saw all this bad news about Tesla, things about Elon Musk, all sorts of different things. But as Buffett says, buying doom, selling boom. Right now, Tesla is booming. And if I go to that monthly chart, you can see here how it moves up, goes sideways, moves up, goes sideways. It came down, it's moving up. So I expect not to run as fast here in 2020. But so if you are looking to get into Tesla, now's not necessarily the time to be doing that. I think now that the time was way back here, basically late last year when I was saying to Jim, I like Tesla. I think you should be getting into it. But right now, I think you should be holding if you do own it. If you don't own it, stay out of it. I want to look at a couple of other ones. This is Salesforce. It's done really, really well this year. It's really up 8 or 9% so far this year. And we've seen a beautiful big bar here on January. Now, it has been a beautiful, steady, rising stock, as you can see. And these are the stocks you really put in your portfolio and almost buy and hold. And you'd almost get me to say buy and hold with something like this, but I don't normally do that. But again, you can see this period of sideways move from sort of 2018 through here. It's now taking off and moving up again. So I think we will see this stock continue to move up for the foreseeable future. So I do like Salesforce at this point in time, and it has taken off. Another one is Google. Google was a bit more subdued last year, rather than unlike Apple, which was up, I think it was over 90%. Apple was up, and we're looking at that next anyway. But you can see here how Alphabet, or Google, is just another big, beautiful, steady stock. Now it is going a little bit more vertical at this point in time. It has taken off quite sharply this year so far. I think it's up about 8% this year. But looking at it, whether that's sustainable, and you can see it's a very sustainable looking rise. It's not really, if I put out using a trend line tool and just go in here and I'll show you, you can see how it sort of runs around that sort of angle, goes up and down and around it. So it's pulling away from it, but it is a very steady performer. But I do think this stock will still continue to rise throughout 2020. Now, on the other scar here, we got Apple. Now, Apple, huge move last year. Now, if I bring that up, you'll see that absolute massive move that it had. So let me go to, there's August 2019. Let's go back to here. So here's January 2019. You can see how it ran very, very hard. It doubled in price in 2019, and it started off 2020 very, very strong as well. Now, that will run out. When you see big moves like that, where you're seeing it's blowing off. Now, if I do the same thing here, with Apple, as I just did with Google, you can see it's a much more volatile stock, not as steady, and you can see that real big solid move here. It's very, very strong, very, very fast. This is where normally the amateurs get in thinking, oh, I'm going to miss out, and that's that fear of missing out, or FOMO, fear of missing out. And people, the amateurs or the uneducated, get in to Apple thinking it's going to rise 100% again. It's not going to do that in 2020. So be very, very careful about jumping into stock. I love Apples. I love Apple stock. I love Apple products. So, and like the rest of the world, but everything gets too expensive at a period of time. Now, people will say, well, I could have bought Apple at, $140, not $300 and something dollars. And I could have bought it at that not too long ago. So it does start to get in our minds too expensive. It will phase back. It'll start to drift back towards this sort of longer term momentum that you can see on the chart. So again, I'd stay out of stocks that have been rising heavily. You need to be looking at stocks that have been going down or haven't been performing well, or those worst performers. We did look at that here in Australia in our live show, or our live YouTube show late last year, our last show for last year. We did look at world markets and see which ones perform better. Now we're looking at the Nasdaq performed the best, or one of the best markets in the world last year, where the Dow was sort of mid to bottom of that range of the world markets. The S&P 500 was in the middle of those. So look at some of those stocks in the Dow, because the Dow was held back a little bit from the S&P 500, mainly because the S&P 500 was the technology stocks that did well, like Apple. So I'd be looking at some of the other stocks that are in the Dow, some of the ones that haven't performed as well in the Dow, for looking for opportunities for 2020. But I'll have some more in my coming reports over the next few weeks when I really start to get into the market again. I really haven't had a big look at the US market and stocks at this point in time. So, but keep watching the show to find out more. But if you have any questions you'd like me to answer, I'm really happy to do that. I love answering questions. Just stick them below. It needs to be on the US market. If you got stocks, so if you do have a question, get on the keyboard, start typing, use your fingers, and let me know what it is you want me to talk about. Remember, I do these reports every week, so hit that subscribe button now and click the bell on the right of it so you know when we do go live with these reports. But for now, as I said, if you've got any questions for me, if you'd like me to look at a US stock for you, just stick it down below in that chat box and I'll get to it next week. But for now, I'm Dow Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.